Hello guys, Mr. Solution here. So in today's video we are going to be talking about Bollinger Bands. Bollinger Bands is actually one of the indicators used in technical analysis. So we start off immediately. We are going to be analyzing repo SRP BTC using Binance Exchange. Okay, SRP Bitcoin using Binance Exchange. Okay, so you wait for it to come up. Wait for it to load up, and it has finally loaded up. We go to full featured charts for us to have a broader view of what we want to analyze. Okay, all right. While it's loading up, let me just tell us a little bit of what Bollinger Bands are. It was actually introduced by one trader by name John Bollinger, who plotted two standard deviation away from the simple moving average. Okay, so this is just grammar. When we get to the issue, we'll talk more about it. All right, so let's change our time frame to 1 hour. Our time frame to 1 hour. So that means we are analyzing the market using 1 hour time frame. Okay, we go to our indicators to search for Bollinger Bands. Okay, is here already? Okay, it's up. All right, this is Bollinger Bands. These are the Bollinger Bands. There are actually three. There are three here. This is the upper band, the middle band, and then the lower band. Conventionally, some traders believe that when price gets to this lower band, it is time for you to buy, and when price gets to the upper band, it is time for you to sell, which most of the time doesn't always follow through. It doesn't always play out that way. We'll still talk about it as we progress. Okay, so when we talk about standard deviation from the simple, these are the standard deviations that we are plotted. These two bands that are the standard deviations that we are plotted away from this. This is the simple moving average. So the middle band represents the simple moving, and that's 20-day moving average. That's what this middle band represents. So buyers believe that when price gets to this lower band, like I said initially, it is time for you to buy. Gets here, it is time for you to sell. But then I also want us to note that it's not always true. It's not always true in the sense that before you can use these Bollinger Bands, in fact, before you can use any of the technical indicators, you have to pay particular attention to the trend. What is the trend of the market? What is this trend saying? Are we in an uptrend or are we in a downtrend? Because when you have carefully articulated and noted this, it will help you to make good decisions as to when to buy and when to sell. There is no need shorting a market that is in an uptrend because it has gotten to the upper band. Let me see if we can get a typical example of what I'm talking about. So that's okay. All right, let's look at this. Okay, all right, I think this is a clear example of what I was just trying to say. Look at this market. Okay, this is actually a trending market. All right, this is a trending market. Maybe assuming you got in here, assuming you got in at this point, and then you believe that the market, okay, that the market is, because the price, you felt that probably because the price has reached the upper limit. Okay, this is, we are analyzing that the price has reached the upper band. Because of that, you will not sell. Okay, if you had sold, assuming you sell at this point, okay, it would have saved you some losses. Okay, but now after here, the market now entered a trend, an uptrend. So if you short when you are not supposed to, okay, it will cost you lots of damages, will cost you lots of losses, so to say. So it's always good for you to pay particular attention to the trend in the market. If it is an uptrend, know that it's not always good to short. By short, I mean to sell in an uptrend. So you should rather be looking at good positions to enter when market is in an uptrend. But when the market is in a downtrend, it's always good for you to know at the right position for you to buy, for you to sell rather, please. When the market is in a downtrend, you should know when to exit it, unless you are margin trading. Okay, so another thing we should also take note of is if we are in a range market. For instance, let me look at, okay, here, this market is actually ranging. This is actually a ranging market. And then one thing you should also observe is understand is that whenever the market is ranging, we will discover that the three bands, they are kind of getting constricted. They are kind of getting constricted in the sense that the standard deviation from this middle band is not that big. Like, they are getting constricted. You can see that it's getting tightened. So whenever the market is getting tightened, it is an indication that something is going to happen. What it actually means is that the volatility is reducing. When a market is ranging, or maybe when the bands are getting closely knitted, when they are getting tightened up together, is an indication that the market is losing that the volatility of the market is reducing. And what happens when a volatility reduces? It means that there is going to be a subsequent increase in volatility. So any reduction in volatility will always be followed by an increase in the volatility. For instance, look at what happened here. We saw the bands were getting tightened. There is no really kind of it's like a balloon. Like, the balloon has not really been that much bloated. A balloon that you are still blowing air. As you're blowing air into a balloon, it doesn't expand immediately. So that is actually what happened there. Until you got to this very stage, what happened? We saw a sharp drop, and then the bands expanded. So whenever a market is tightening like this, whenever the bands are together like this, you should be very careful. You should pay particular attention to what is actually happening in the market, because it might actually the result could be that the market might increase, okay, or decrease. So just like what happened here, from here we saw a tightening. Okay, there was a tightening until it got to this very place. We now saw a sudden outbreak or sudden outburst, but then the outburst was in the negative form. So if you're actually margin trading, this is actually a time for you to make very cool profit, because if you short from here, okay, to here, even though there was a little breakout table, if you had shorted from this point to this very point, that's actually a massive profit for you, and maybe you entered back again at another profit. So we should always be very mindful. These are the rules governing when you are using the Bollinger Bands to trade. Always be mindful of the constriction. If you can go back, you will discover that anytime there is a tightening, there is usually a subsequent outburst. After the tightening comes an outburst. Okay, so when there is a reduction in volatility that causes the tightening, the next thing that will follow is an increase in volatility, and that increment could either be in the positive or in the negative. So when you are trading a ranging market, be very careful, because it means that the volatility is reducing and you may not know what next that will ensue. Okay, so like I said, we said that that the standard deviation determines how overstretched the market is. The higher the standard deviation, the more overstretched the market is. Okay, so the higher the standard deviation, for instance here now, we can see that between this upper band and the lower band, okay, that the standard deviation is higher. Hence the market became overstretched. Okay, the space between the upper band and the lower band became more pronounced. All right, so I also want us to understand that when you notice that the bands are coming together, it means that the volatility is shrinking. Like I said it before, when you notice that the bands are coming together, it means that the volatility is shrinking. And then after the volatility shrinkage comes the volatility expansion, so which will be followed by a massive move in the market. The move could be either negative or negative. For instance, here we saw it was actually a negative because price dropped massively. Okay, let me know if I can see another typical example of the shrinkage. Okay, all right. Like I have equally said earlier that you should pay particular attention to the trend. Let me change this to 30 minutes to know if we can get something. Okay. All right. Look at that. Okay, this is actually the same one we talked about initially. Okay. The constriction of the bands, both the upper and lower bands, meant that there was a shrinkage in the volatility of the market. There was a reduction in the volatility of the market, which followed immediately with a rapid increment. Okay, you can see the distance between the upper band and the lower band. Okay, so which equally led to an uptrend. The market went up. So here we saw an uptrend, a sharp move, which continued until it got to this very point. Like I said earlier, it is believed that when the price gets to the upper band, it is time for you to sell. When it gets to the lower band, it is time for you to sell. So which is not always true. Okay, for instance, you can see from this very place that even when the price got to this point, got to the lower band, okay, it even went lower. It went lower before it picked up again. So you can actually use this. You can actually use this the middle band, middle band, to tell you when to sell or when to buy. Okay, you can use it as a gauge as to know when you are selling and when you are to buy. But then attention should be paid strictly to what the market is saying. What is the price action? Are we in an uptrend? Or is it a downtrend? And as usual, it is not always good for you to short a market that is in an uptrend. Okay, when a market is an uptrend, you should be looking for good positions to enter. Okay, so then there are a few things I want us to note before the video finally ends, which is that you should beware of trading against the trend. If market is an uptrend, do not trade against it. If market is going up, do not try selling. Rather, you should be looking for good position. I cannot emphasize this enough. And then that you should know that a squeeze is followed by a breakout. A squeeze, when there is a constriction, when there is a reduction in volatility, it is usually followed by a breakout, which could either be negative or positive. Okay, let me change another time frame. Okay, so you can see. And then another thing I also want us to understand is that you can train your stop loss by you can train your stop loss by focusing on this 20 moving average, the middle line, the middle band. You can train your stop loss. Maybe if a market is in an uptrend, I wish I could see a market that is in an uptrend, then you can always try to be training your stop losses at those and at the various points of the middle band. So simply, let's just bear in mind that the function of the Bollinger Bands is to tell us the volatility of the market. It tells us what is happening in the market. Are we having much? Is the market highly volatile, or is there a reduction? And whenever you're seeing a reduction in volatility, it is usually indicated in the Bollinger Bands by a squeezing. Okay, the three bands usually come together as we have here. Okay, you can see as we have here. So that is just all for Bollinger Band. But then, as I always say, you do not base your trading decision on what these indicators tell you. You do not just come to the market and decide to trade from what the Bollinger Band has shown you. You should try as much as possible to kind of combine it with other indicators so that we give you the right decision. You have the opportunity to make the right decision. All right, guys, I hope the video has been able to educate you and then made you to understand what Bollinger Bands are. Until I come your way again, yours in the business of trading. Mr. Solution.